Right now, one number sitting on your last tax return is quietly deciding what shows up in your bank account this August. Not a letter from Service Canada, not a phone call, one line, line 23600, and if it moved even a little from last year, your guaranteed income supplement, your old age security, or both could shift without any warning landing in your mailbox first. I've had seniors call me in a panic in August because their deposit was $200 lighter than July, and nobody had told them why. So today I'm walking you through exactly what line 23,600 is, exactly what it's worth to your monthly payment, and exactly what you can do right now before the next reassessment to protect what's yours. Stick with me to the end because point 4 is the one almost nobody checks, and it's the one most likely to be quietly shrinking a senior's GIS without them ever knowing why. And near the end, I'm going to show you exactly what to do if your payment already dropped and you think CRA got the math wrong, because that path exists and almost nobody uses it. Point number 1, what line 23,600 actually is. Let's start plain. Line 23,600 on your T1 tax return is your net income, not your pension income alone, not just your CPP. It's everything added up: CPP, OAS, RRIF withdrawals, workplace pension income, investment income, even taxable capital gains minus certain deductions before your age amount and other credits are applied. Think of it as the number CRA uses as your financial report card for the year. And here's the part that catches people off guard. This isn't a one-time number they check when you turn 65. Service Canada pulls it fresh every single year to decide what your guaranteed income supplement and your old age security should look like for the next 12 months. So if your RRIF minimum withdrawal went up this year, if you sold some investments, or if a small part-time job added a bit of income, that number moved. And when it moves, your payment moves with it. Here's something worth sitting with for a second. A lot of seniors assume their retirement income is set once they retire, a fixed pension, a fixed CPP amount, a fixed OAS amount done. But line 23,600 doesn't care that your income feels fixed. It only cares what actually landed on your tax return that year. That means 2 years that feel identical to you, same lifestyle, same spending, same routine, can produce two completely different line 23600 numbers simply because of when a RRIF withdrawal happened, when a GIC matured, or when a capital gain was triggered. Point number 2, what it's worth to your August deposit. Here's the mechanism most seniors never get explained to them clearly. Old age security is topped up 4 times a year for inflation, a small quarterly bump that everyone on OAS gets, regardless of income. But your guaranteed income supplement works completely differently. GIS is fully recalculated once a year, using the tax return you just filed, and that recalculation flows through starting with the July payment. If there's a delay in processing your return or your income situation shifted meaningfully, you may see the adjustment reflected as late as your August deposit, which is exactly why so many seniors notice the change in August and not July. Here's a real-world way to picture it. Say a retired senior named Margaret had a modest RRIF withdrawal last year that pushed her reported income up by a few $1,000s because she needed extra money for a home repair. That one-time bump doesn't just disappear. It becomes the number CRA uses to calculate her GIS for the entire following year, even though her actual day-to-day income went back to normal. Her GIS drops, her total monthly deposit shrinks, and unless she understands why, it looks like the government simply cut her off for no reason. That's the trap. GIS is income tested, and it's tested on last year's line 23,600 NIs, not on what you're actually living on right now. Now flip that example. Picture a senior named Walter, a retired machinist who picked up part-time seasonal work 2 winters ago to help cover a grandchild's tuition, then stopped working the following year. His income spiked one year, dropped the next, but GIS doesn't know that in real time. It's always looking backward at the return you just filed. So his GIS dropped the July after the higher income year, even though by that point he was already back to living on pension and CPP alone. That lag is the single most misunderstood part of this whole system, and it's the reason so many seniors feel blindsided. Now I know what some of you are thinking. Is this legal? Can they really just lower my payment without telling me first? Yes, and it's not a mistake. It's the system working exactly as designed. GIS has always been recalculated annually off your net income. The problem isn't that it's illegal. The problem is that almost nobody explains it to seniors in plain language before it happens. That's exactly why we're doing this video. Point number 3, how much money is actually on the line? Let's talk real numbers, because your payment might change isn't good enough. You deserve to know the scale we're talking about. For the current benefit period, OAS increased 1.2% for the July to September quarter, bringing the maximum monthly OAS to roughly $751.97 for seniors 65 to 74, and about $827.17 for seniors 75 and older. That part is guaranteed and automatic. Everyone gets it, and it has nothing to do with your income. GIS is the piece tied to line 23,600, and it's recalculated using a sliding scale. The higher your net income from the prior year, the lower your GIS. For a single senior with little or no other income, combined OAS and GIS can land somewhere around $1,800 to $1,900 a month. But push your reported net income up by even a few $1,000s in a given year through a larger RRIF withdrawal, some investment income, or part-time work, and your GIS portion can drop by a noticeable amount the following July, sometimes by more than what most seniors would guess for that size of income bump. And here's the piece that really matters for higher income retirees watching this. The OAS recovery tax, what most people call the OAS clawback, kicks in once your net income crosses roughly $93,454 for the current repayment period. For every dollar above that line, 15 cents of your OAS gets taken back. Cross around $154,700 and your entire OAS pension can be clawed back to zero. That threshold is also based on, you guessed it, line 23,600. So this one number is doing double duty. On the lower income end, it's shrinking your GIS. On the higher income end, it's triggering the clawback on your OAS. Different program, same trigger line. Let's put this in a comparison that actually shows the stakes. Take two married couples, both age 68, both retired, both with roughly the same lifestyle. Couple A draws their extra spending money from a joint TFSA. Couple B draws the same amount from a joint RRIF. On paper, they spend the same, live the same, and feel financially identical day to day. But Couple B's line 23,600 is meaningfully higher because of where that money came from. And when GIS and clawback calculations run the following year, Couple B can end up receiving noticeably less combined benefit income than Couple A purely because of account choice, not because of how much they actually spent. That's not a hypothetical quirk. That's the exact mechanism built into the system, and it's why the account you draw from matters just as much as how much you draw. Point number 4, the one most people never check. Here's the point I promised you at the start. The one almost nobody checks. TFSA withdrawals do not appear on line 23,600. Not partially, not at all. CRA doesn't see them as income, so pulling money from a TFSA has zero effect on your GIS calculation and zero effect on your OAS clawback. Compare that to pulling the same dollar amount from an RRSP or RRIF. That money is fully taxable. It lands on line 23,600, and it can quietly shrink your GIS the following July or trigger part of the OAS clawback if you're in that higher bracket. So if you have a choice about where to draw extra cash from this year, for a home repair, a car, a gift to a grandchild, the account you choose isn't just a tax question, it's a benefit protection question. Two seniors can pull the exact same amount of money and end up with completely different GIS payments next July, purely because of which account it came out of. There's a second layer to this a lot of people miss. The sale of your principal residence also doesn't count toward line 23,600 DORs, so a home sale gain is generally excluded from net income for these purposes. So a senior who downsizes and sells the family home doesn't automatically trigger a GIS reduction or an OAS clawback just because a large amount of money moved through their bank account that year. That surprises a lot of people because it feels like it should count. It doesn't. I can already hear the next question. Won't my accountant catch this automatically? Maybe if you have one and if you specifically ask about GIS impact rather than just asking them to file your return correctly. Most tax preparers are focused on minimizing what you owe this year. They're not always thinking about what your line 23600 number does to your benefits 12 months from now. That's a different lens, and it's on you to ask for it directly. Point number 5, how to actually manage this going forward. So what do you actually do with this information? First, before you make any large withdrawal from an RRSP, a RRIF beyond your minimum, or by selling investments with a capital gain, ask yourself whether that withdrawal is going to land on line 23,600 and whether you're close to either the GIS reduction zone or the OAS clawback threshold. If you're not sure where you stand, request your notice of assessment from CRA. It shows your net income clearly. right there on the page that mirrors line 23,600. Second, if you're married or common law and one of you has meaningfully higher income than the other, look into pension income splitting using CRA Form T1032. Splitting eligible pension income, this includes RRIF withdrawals after 65 and defined benefit pension income, and can shift income from the higher earning spouse to the lower earning one, which can reduce or eliminate an OAS clawback and in some cases help protect GIS eligibility for the lower income spouse. Third, file on time every single year without exception. Service Canada can't recalculate your GIS accurately, and in some cases won't issue it at all if your return is filed late. A late return doesn't just delay your refund, it can pause or delay the benefit payments seniors are counting on to cover rent, groceries, and medication. Fourth, if a withdrawal is unavoidable, say a furnace breaks down and you need $4,000 fast, check your TFSA balance first. Pulling from there instead of an RRSP or RRIF keeps that expense completely invisible to your line 23,600 calculation, which means it won't follow you into next year's GIS reassessment at all. Fifth, and this one applies specifically to anyone approaching 65 who hasn't started OAS yet. Deferring OAS past 65 increases your monthly pension by 0.6% for every month you wait, up to a maximum of 36% more if you wait until age 70. If you're still working part-time or you have other income keeping you above the clawback threshold, deferring can mean you avoid the clawback years entirely during the deferral window and lock in a permanently higher base payment once you do start. One more thing, seniors always ask me, what if my payment already dropped and I don't know why? Call Service Canada directly and ask them to walk through your GIS recalculation with you. They can tell you exactly which year's net income they used and what changed. Don't just assume it's a permanent cut. If your income drops significantly this year compared to last year, say because a spouse passed away or you stopped part-time work, you can request an income estimate reassessment rather than waiting a full year for the numbers to catch up. Point number 6, what to do if you think the number is wrong. This is the part almost nobody talks about, and it's exactly what I promised you earlier. You are not stuck waiting a full year if your income situation genuinely changes. If a spouse passes away, if you're widowed, if you or your spouse stop working, or if your income drops for a documented reason, you can ask Service Canada to estimate your current year income instead of relying purely on last year's tax return. This is sometimes referred to as a statutory declaration of estimated income, and it exists specifically so seniors in a sudden income drop aren't stuck living on a stale higher income calculation for 12 months while their real situation has already changed. The key word there is documented. This isn't something you request just because you prefer a bigger payment. It's for genuine, verifiable changes in circumstances. But if that applies to you, don't sit on it. The longer you wait to report the change, the longer you're receiving a payment based on outdated numbers. And if you believe CRA or Service Canada simply made a processing error, the wrong figure was pulled from your return, or a slip wasn't matched to your file correctly, you have the right to request a formal review. Keep copies of your Notice of Assessment, your T4A OAS, your T4AP for CPP, and any RRIF or pension slips together each year. When you call to question a payment, having those documents in front of you turns a frustrating phone call into a 5-minute conversation because you can point to the exact number in question instead of describing it from memory. Point number 7, the mistake that costs seniors. The most I want to close the list with the mistake I see costs seniors the most money over time, and it has nothing to do with the amount of income you report. It's about never applying for GIS at all. Some seniors assume that because they have a modest workplace pension, they automatically don't qualify for GIS, so they never even apply. But GIS eligibility is based on your actual net income each year, not on whether you have a pension at all. A retired veteran living on a modest pension and CPP, a widow living on a survivor's pension, or a retiree whose RRIF has been steadily drawn down over the years can all find themselves under the GIS income threshold in a given year, sometimes for the first time years into retirement, without realizing it simply because their income naturally declined as their savings drew down. If you've never applied because you assumed you wouldn't qualify, that assumption should be revisited every single year, not just once. Your income this year is not your income 5 years ago. A senior who didn't qualify at 66 can absolutely qualify at 74, especially once RRSPs are depleted and income shifts to CPP and OAS alone. Checking your eligibility takes minutes. Missing it can mean leaving thousands of dollars a year unclaimed year after year simply because nobody rechecked the number. Here's what I want you to walk away with. Your August payment isn't random, and it isn't the government being unpredictable. It's math, running off one line on a tax return you filed months earlier. Once you understand that line 23,600 drives both your GIS and your OAS clawback, you stop being surprised by your deposit and you start being able to plan around it, which account to draw from, when to split pension income, when to double-check your notice of assessment before a big withdrawal, and when to ask for a reassessment instead of waiting a year. That's the difference between reacting to your retirement income and actually managing it. It's a small shift in how you think about withdrawals and filing, but over 5, 10, 15 years of retirement, it adds up to real protected money, money that stays in your pocket instead of quietly disappearing into a recalculation you never saw coming. If this helped make sense of something that's confused you for years, do me a favor and share it with another senior in your life, a neighbor, a sibling, someone at your church or community center who's on GIS or worried about the OAS clawback. This is exactly the kind of thing that spreads best person to person, because most seniors are Googling their payment questions alone at 11 at night, not finding this. Drop a comment and tell me what your August payment looked like this year. Did it go up, stay flat, or drop? I read every single one, and it helps me know what to cover next. And if you want to stay ahead of the next CRA rule change before it hits your bank account instead of after, hit subscribe and turn on notifications. I put these breakdowns out regularly, and the goal is always the same. Make sure you know what's coming before it shows up as a smaller deposit. Take care of yourselves, and I'll see you in the next one.